Good evening, everyone. I'd like to welcome you to our webinar and thank you all for your attendance. In today's webinar, we will discuss income tax issues faced by agricultural producers and give an overview of the Tax Cuts and Jobs Act and tax management strategies during times of drought. My name is Jenny Beiermann. I'm an agricultural and business management economist with Colorado State University Extension, and I will serve as your webinar host this evening. Our speaker for the evening is Jeff Tranel, who is also an agricultural and business management economist with Colorado State University Extension. Jeff has been with Colorado State University Extension for 32 years. He is a member of the National Farm Income Tax Education Task Force. His professional focus is estate planning, business succession, income taxes, financial management, and human resource management. Throughout the webinar, we would like you to have the opportunity to ask questions. We ask that you please do so using the chat function found on the bottom toolbar of your screen. After clicking on the chat function, a box will appear on the right of your screen. Using the box, please type in your question and press enter. I will find the appropriate time to ask the questions to Jeff as they are submitted in the chat box. If you are listening in via the audio on your phone, you will also have the opportunity to ask questions. We just ask that you wait until the end of the presentation, at which point I will open it up to questions over the phone and you will be able to speak. We also ask that if you are having technical difficulties, that you please notify us through the chat function as well, and we will do our best to resolve the issue. We would like this webinar to be a good and positive experience for everyone. If you have not already done so, we ask that everyone please mute the microphone on their computers. This can be done using the toolbar at the bottom of your Zoom screen. If you are using a cell phone, we also ask that you mute that as well so as to avoid excess background noise. If you are having trouble viewing the text on the slides, you may want to enter the full screen mode, which can be done by pressing Alt-F on your keyboard. Just a reminder, we are recording this webinar and it will be available for you to view and watch again. Please allow us a few days to post it online. You will be able to find it at the link displayed on your screen, and I will also post this link in the chat box for you all to see. This information is also available on the webinar flyer we distributed. At this point, I would like to turn the webinar over to our speaker, Jeff, to share his information about income tax management and strategies. Jeff, thank you for being here this evening as our speaker.
You bet. Thanks, Jenny. I appreciate this opportunity to share just a few of the selected issues related to Tax Cuts and Job Act, as well as a few tax strategies that we might use during times of drought. It is important that I share with everyone that I am not a CPA, and nor am I your tax preparer. This is important because not that I am one or the other, but not being your tax preparer, I do not know your particular situation. There tends to be some gray area in the tax code, so your tax preparer would need to match your philosophy with your situations in that reporting mechanism. I want to note that for-profit farming is an activity presumed to be a business if there is net income or profit in 3 or more of the last 5 years. For activities consisting of breeding, showing, or raising horses, the presumption arises if there is a profit in any of 2 of the last 7 years. The IRS can rebut the presumption by carrying the burden of proof and establishing a lack of profit motive. If the business fails to meet the profit test, certain factors may be considered to determine intention to be profitable. The taxpayer does not have to qualify on each of these factors. The cumulative picture will provide the basis for the determination. Some of the factors, but not all, include the farm is operated in a business-like manner, the time and effort spent on farming, the taxpayer depends on farm income for his livelihood. This is an important one when the taxpayer has one or more of the spouse, let's say it's a mom and dad, and or both of them have jobs off the farm, is it truly still a business? Do they depend on farming for their livelihood? Of course, losses beyond circumstances beyond the manager's control. There's profit in some years and not in others, which is typical of agriculture. Also, you expect profits in future years. There's a whole list of these, and again, it's a cumulative picture that forms intent to profit. If you are not a for-profit business, you then become or have a hobby farm. And I want to point out at this point in time that farm is the general term, but by that I also want to include a ranch. So we have farms and ranches, one and the same. Farm is a term used by the IRS. Hobby farms are generally those people operating an agricultural enterprise where profit or farm income is not the primary motive for the taxpayer. Hobby losses are generally deductible only to the extent of income produced by the activity. So if you have $3,000 in income and $25,000 in expenses, you're limited to that income. And it's reported on the 1040 as opposed to Schedule F. Now, as you work with your tax preparer, the actual form you will use for reporting this will be determined at that time. I want to take a few minutes and discuss with you some of the special issues related to drought. Before a producer can make an informed decision, he or she must know what it costs to run a cow or other breeding female for the year. For the beef producers, it's the cow cost. If you are a sheep producer, it's going to be per ewe or whatever it is. The terminology doesn't matter. It's simply the cost to run that cow for the year. Before a taxpayer makes a decision, what are the tax consequences of selling those cows, of buying food, going through all the options? What about loans? If there are proceeds from the sales, are they going to have to be used for paying off existing debt? Or can it be used for repurchasing animals, paying off future debt, whatever that is? What is going to be the tax consequence of whatever strategy implemented on the equity position or the net worth of that producer? And of course, there's a personal consideration here as well. Some people really have fallen in love with their ewes or their does or cows. Their life has evolved around or revolves around those animals and caring for those animals. What is that person going to do without that activity? And of course, you need to make some estimate of future prices and profitability before you take action. It is critical that you know this information before you take action. It is very difficult, if not impossible, to change the tax consequences after you've already sold those animals. There are 4 basic strategies for livestock producers during times of drought. And drought is a constant concern in Colorado. Almost every year there is some area in the state impacted by a shortage of moisture. So when faced by a shortage of forage or grass caused by a drought, the producer has basically these 4 choices. May choose to buy feed, keep the cows on the place or the ewes or whatever it is, those animals stay on the place. Of course, that increases the expenses associated with keeping those animals. Might want to move those animals to another locale. It's Much easier on those animals to move more north and south because the forages are more similar, rather than, say, from Colorado to Missouri or Illinois. And what are the costs and production consequences of that? Producer may choose to sell the breeding animals and plan to replace those in the future, and I'll talk more about that in a bit. Or he or she may choose to sell the cows and get completely out of the business of raising breeding animals, being a cow-calf producer, or use having lambs, whatever it is, without any intention to replace those animals. We have a number of tools to help producers evaluate these options. They are available on the ABM website. You saw it on the opening slide. I will give that to you at the end. Some of the examples we have are matching cow size to available forage, buying hay versus selling the cows. Very simple templates. They're not designed to give you real specific, detailed information, but it puts you, as I like to, one adage would be, I'm not selecting the pitch that the pitcher's going to throw to that specific batter, but it's making sure we're in the right ballpark and maybe starting the starting lineup. What can you afford to pay for a cow? This is one in purchasing those animals. Calculating your cow cost, and then of course we have a spreadsheet or a worksheet with 4 different options on strategies for the cattle herd during times of drought, looking at comparing the finances only of the 4 options I discussed earlier. So now I want to go back to some selected topics on farm income. These would be reported on the Schedule F, which is where you would report those. Schedule C would be for business activities, non-farming business activities. The IRS is really paying attention to, and it's becoming a more complex issue in today's world, the difference of reporting income and expenses on Schedule F versus Schedule C. The processing incidental to growing and harvesting a crop or an animal is considered a farming activity. Processing beyond the minimum need to prepare it for initial sale is not a farming activity. For example, if you normally have cut flowers, you harvest those cut flowers, you put them in boxes and send them off, that would be a Schedule F activity. Income from that would be reported on the top half of Schedule F, and the associated expenses would be reported on the bottom half in Part 2 of the Schedule F. However, if you take some of those flowers and put them in a vase, put some other flowers with it, baby's breath or whatever florists do, you send that off to the florist, or you take it to a farmer's market and sell that, that is actually a Schedule C activity because you've added value to each stem of those cut flowers. In the case of wool, if you have sheep, the initial cleaning of those would be okay as a Schedule F, but if you do more than that, let's say you clean it a couple of times and then you cart it out really well, that becomes a Schedule C activity because you're selling it into a market beyond that initial sale. If you are a beekeeper, there are specific rules related to honey production, and those are less limiting. You can put the honey, actually you can clean it some, or whatever the appropriate terminology is there, put it in jars and sell it. That would all be a Schedule F activity. Where it becomes Schedule C is the portion of those honey jars in which you may add lavender or chili peppers or peanut butter or whatever the case is. You've added some value to go to a very specific niche market beyond that necessary for initial sale. Somewhat coming back to the weather-related activities, an eligible producer in an area designated for assistance by the federal government due to weather-related conditions may choose to postpone reporting certain sales. You must, to be eligible for this, you must be a qualified farmer. You must use the cash method of accounting. These next two parts of the Internal Revenue Code that I'm going to share in the next few slides relate to the animals sold in greater number than would normally be sold. So the first one is Internal Revenue Code 451E, which allows for the income from the sale of animals due to weather-related conditions to be deferred until the next year. This part of the tax code pertains to young animals, breeding animals, and all other types of animals. There's no limit here. The animals do not have to be raised nor sold in the declared disaster area, but a weather-related condition must have caused the premature sale of the animals. For example, you are a beef cattle producer. You keep animals in one county, which is not eligible for federal assistance, but then they're there in the summer. You have to sell them because the drought caused you not to have forage on the home place, which is in a county or other area eligible for federal assistance. You can still make a 451E election, but it has to be a weather-related condition that caused this sale. And again, it is the number of animals beyond what would normally be sold that can be deferred. Here's an example of that. A producer normally sells 100 head of beef cattle per year. As a result of the drought, producer sells 135 animals. Further, let's assume the affected area was declared a disaster area eligible for federal assistance. The producer would be able to defer for 1 year the income generated by the sale of the extra 35 head. Income from the sale of the 100 animals, whatever they would be, cows or calves in this example, you would have to report that income in the appropriate place on Schedule F and other forms for the breeding cattle. And on that 35 head, you would simply defer that to the next year. There are we have on our ruraltax.org website some great examples of this and some fact sheets pertaining to that. I will give you that website later on. The one that's very commonly talked about, especially by cow-calf producers and other breeding livestock producers in Colorado, is Internal Revenue Code 1033E. This pertains to the sale of livestock held for draft, breeding, or dairy purposes. It does not include poultry, but those others. Taxpayer may choose to defer recognition of the revenues generated from the sale of eligible animals, again, if the sale is due to weather-related events and conditions. Further, it's important to note that by making a 1033E election, the taxpayer is indicating to the IRS that he or she plans to replace those animals. Whereas the 451E does not have a replacement component to it. Once again, it pertains to the number of animals greater than would normally be sold. The replacement property must be similar or related in service or use. For example, if you sell your breeding ewes, you must replace those with breeding sheep females. You can't replace them with a tractor or anything else. Now, there may be cases, and we've seen this in Colorado, where those weather-related conditions, i.e. the drought, persist for a longer period of time. It may not be feasible to replace the sold ewes with other breeding sheep, so you can buy other types of assets, such as a tractor or a piece of equipment, but it must be used for farming purposes. Again, all of this is related to farming or ranching. Now, that replacement period I talked about is either 2 years or 4 years. So the replacement period begins on the date of sale or damage. So let's say you sell now, which is May 10th of 2018. You have until the last day of the first tax year in which it was the gain was realized. So you would have until December 31st of 2020 to replace those animals. In certain cases, you can have 4 years to replace those if it is weather related in an area eligible for federal assistance. Maybe you are just selling those cows more than normal because it's dry in your area, but the county has not been declared eligible for federal assistance. You can still file a 1033E. You have 2 years to replace those. Now remember that counties declared disasters and eligible for federal assistance are the specific counties declared eligible plus the adjoining counties are also eligible for these tax code applications. Another form of farm income is agricultural payments, and these can include reimbursements for feed purchased during times of drought, CRP payments, whatever those are, and you will the taxpayer will receive a Form 1099-G from the federal government listing all of those. And it may not get very specific, but it will give you a total amount. The taxpayer should report that dollar amount. What you report on your Schedule F should match the 1099-G. And then if there needs to be adjustments, the tax preparer will offset that income with an outgoing expense. So for example, a father and daughter have a goat herd, breeding goats. They sell all those does, or they get feed for that. Reimbursements for the feed from the FSA office, the Farm Service Agency office. They give you a check to reimburse the feed or whatever the case may be. Dad has the taxpayer identification number listed on the 1099-G, so he has to list the total amount. Because daughter owns half of that herd of goats, Dad would then have an expense of half of that amount of that feed reimbursement check going to daughter. Daughter would need to report that as income on her Schedule F. Crop insurance may be in times of drought or flood or other weather-related condition. You report the gross income in the year it's actually or constructively received. So you get payment this year in 2018, you would report it on your 2018 tax return. However, if you have a crop that you normally harvest in 2018 and then, or in 1 year, and sell in the following year. That is your constant practice. You raised it in 2018, you harvested it, it's in the bin, and you always sell in. You did that in 17. You sell in 2018. You can, and let's carry that forward to 2018. You would normally produce it, but rather than get a crop, you got crop insurance proceeds. You can likewise carry those crop insurance proceeds into next year for reporting to the IRS. If the taxpayer uses the cash method of accounting, receive the insurance proceeds in the same tax year as the crop's damaged, and again, it's your normal practice to sell the crop in the following year. Custom hire work, there's no changes in the new code. It is reported on the Schedule F. As long as less than 50% of the custom work, or the custom work is less than 50% of total farm income. Then if it's more than 50%, the taxpayer would report the farm-related custom hire on Schedule F, and then the excess on Schedule C. There's no real clear threshold, but this can be a case for new and beginning farmers where they're out trying to get extra income, and they're using their farm tractor and tractors and other machinery and equipment to generate income to pay off debt, meet family living costs, whatever the case may be. There would be a reporting difference there. Again, need to have a good conversation with the tax preparer before the end of the year. Jenny, before we go on to farm expenses, are there any questions about farm income or the slides on drought that we should address at this time?
Yes, Jeff, there's a question about farm income. Do I report my patronage dividends from the co-op on my Schedule F, or do I need to report that elsewhere?
If the taxpayers is a member of the local co-op as a part of the farming or ranching activity, then that gets reported on the Schedule F. If I'm a full-time school teacher, as an example, and I like going to the co-op, and they have some products that I really like. I become a member so I can purchase there, but I'm not a qualified farmer. Those patronage dividends would be reported elsewhere, not on the Schedule F.
Okay. And can you talk about how I would report if I have a PRF insurance payment that I get from lack of precipitation?
That is PRF, or pasture rangeland forage insurance, is crop insurance. It is administered by the risk management agency. That is a Schedule F activity. So it would be reported on the Schedule F with crop insurance proceeds.
Thank you. That's all the questions right now.
Okay, we can go on. If there's others that pop up, we can come back to those later on. So the Schedule F is the form on which farm expenses and farm income are reported. Farm expenses are those ordinary and necessary costs of operating a farm or other agricultural enterprise. Of course, capital improvements, other capital purchases are normally depreciated, which can reduce the basis or tax-related value of that asset. Again, the purchase of items for resale are not deductible in the year they're incurred. Rather, they are carried forward under the cash method of accounting to the year in which those items are sold. There is now a limitation to business interest, which is a part of the Tax Cuts and Job Act. They've limited this to 30% of the business's adjusted taxable income. That adjusted taxable income is determined at the tax filer level, other than for the case of pass-through entities like partnerships. The determination is made at that entity level. There's also a limitation in that, or an application of this, an exemption, if you will, for taxpayers with average gross receipts that do not exceed 25 million, which is there are some farming, ranching activities with gross receipts over a 3-year period that exceed 25 million. So this limitation would come into play, but if they're less than that, it's not a concern. A farming business can elect out of this limitation if they choose to use the alternative depreciation schedule to depreciate property used in the farm business with a recovery period of 10 or more years. So it's farm structures and things like that. We generally use GDS, the general depreciation system, which has a specified number of years for cost recovery, or that you would depreciate those items, assets over. The ADS has a longer recovery period. And of course, single purpose structures such as poultry barns, hog houses, that type of thing, also are impacted on this business interest limitation. The IRS, for a number of years now, has been paying more attention to the differences between leases and purchases. Lease or rent payments are deductible in the year they are actually paid, whereas only the interest portion of a debt payment is considered a deductible expense. There are a number of factors which indicate a conditional sales contract as opposed to a true lease. So no matter what it's called, does it look like a lease? Do the factors included in that agreement make it look like a lease, or does it look like a sale or a purchase, whichever the case may be? Some of the factors does part of the payment get applied to equity interest? Is it building equity or your value in that asset? Can you purchase it at a fixed income or a fixed amount, or some amount different than fair market value? Likewise, if the agreement designates any part of the payment, the lease payment, so-called lease payment, as interest, or it could be recognized as interest, the IRS is going to consider that agreement to be a conditional sales contract or a purchase as opposed to a lease. Items purchased for resale, I hit this earlier. For those farm taxpayers that use the cash method of accounting, the cost of purchasing animals or other items for resale are reported in the year in which the assets are sold. Now, if you are putting plants in the ground and they have a pre-productive life of greater than 2 years, so you're not going to be able to harvest those for a period greater than 2 years, you must capitalize the cost of not only the plant, but establishing those plants. Capitalizing meaning you're going to depreciate those. Prepaid farm expenses, we normally, we get some better deals in December to prepay for fertilizer or chemicals or buy some feed, whatever the case may be. If we use the cash method of accounting, we can deduct that even though they're not going to be used into the following year, but there are some limitations, and 50% of other deductible farm expenses is generally the limitation on that. Contract versus employee labor. This is another issue the IRS is working on, not only for farmers, but private companies, non-agricultural companies, universities, other governments. This has been, even those of us with Colorado State University have been feeling this tightening, if you will, of people being employees versus contract. There is a list of 20 factors to help you sort through this, but basically, if the business owner has someone do work for him or her and compensates that person for that work, it is an employee. If there is any training involved, if there is any guidance involved, or anything else. A contractor is someone, Farmer X says, I want Billy Bob to come in and bale my hay. Billy Bob has uses his own machinery and equipment, cannot use Farmer X's, has to use his own. He has the skills to do that, to put it up right. It happens. Now, Farmer X could say, you know, I live on a busy highway, we're next to a church, there's a lot of traffic going on Sunday mornings. If you can stay off the highway at that time, that is a fine limitation, not a problem. Farmer X would report the payments to that individual contractor on a Form 1099 miscellaneous, or MISC, if it is an amount greater than $600. For employees, the standard W-2 form is what is used to report that. A farmer or rancher may choose to pay his or her, a spouse or children, wages or other compensation, and then those wages or other compensation would be deductible as farm expenses, as long as there is a true employer-employee relationship and the employee does work that is appropriate, such as you could not pay your 6-year-old to run a big combine. Could go out and there's chores, and we've got when we move cows, there's riding and that type of thing. So that can happen. As long as the activity is age appropriate, skill appropriate, and the person does the actual work. Payments can be made, and the cost of that compensation can be deducted on the farm. Now we get into depreciation. This is that annual allowance that recognizes the obsolescence or the wearing out of assets over time. Can be taken for most types of tangible property, such as buildings, machinery and equipment, vehicles, breeding livestock, and fences. Land is not tangible property because there is no determinable useful life. You begin the depreciation when the assets are ready and available for use. Let's say you buy a piece of equipment and it comes fully put together and it is ready for use. You buy it in December, you can start depreciating it at that time. Conversely, you buy a piece of equipment and it could even be a building. You buy the pieces of the building, a hoop house, high tunnel, and it comes in pieces in the boxes, and you do so in December, and it is sitting there. You don't get around to constructing it until February. In that case, you would start depreciating that asset, the cost of that asset, in next year. So, and there are a number of other limitations on depreciation and strategies for that I don't want to go into tonight because they get rather long and I'm running short of time. Section 179, which allows expensing of the cost of a particular asset, and it has to be qualifying and placed in service. The change in the new tax code or the legislation is that it's limited to $1 million with an overall investment limit of $2.5 million. An exception to this is SUVs and light trucks, which have a $25,000 limitation on this. One of the reasons for the limitation on SUVs and light trucks and other such vehicles is that they lend themselves to personal use. Further, if you choose to the Section 179 expensing on the purchase of your assets, that cost, you cannot use that to put to create a loss on the Schedule F. It can take you down to still a positive number, but it cannot create a loss on the Schedule F. A change on machinery and equipment. The cost recovery period is now 5 years for new machinery and equipment, and used is still 7 years. The old tax code prior to January 1st of 2018 for both new and used was 7 years. And then there's some other limitations that I have on the slide that I don't want to go into. It's just the point, there is now a difference between new and used. The new tax code has includes a first-year bonus depreciation, and it actually applies to both new and used property, whereas in past years it was restricted to new property, and then it goes down from 100% the first year, 80% in future years, etc. Like-kind exchanges. This would be, for example, you have a tractor and you trade it off on a new tractor or a different tractor. Let's just call it that. I want to jump to the next slide because it provides a pretty clear example of how this works. Let's say in 2017, John traded a tractor with a fair market value of $75,000. So that's the old tractor. And it had adjusted basis of 0. So you had depreciated it out or used Section 179 expensing to take it down. But he buys a new tractor with a fair market value of $125,000. So what he does is he trades in a $75,000 tractor and has a boot of $50,000 to equal the $125,000. Under the old law, the depreciation recapture was deferred, i.e. the 0 basis just went into computing the basis of the new tractor. In this case, it would be only a $50,000 basis, which is the cash amount. Under the new law, John must recognize the sale of that $75,000 and pay either depreciation recapture if applicable or capital gains on that amount. And then the basis in the new tractor is $125,000 or the full purchase price of the new tractor. So it's a two-step process now, whereas it was a one-step process. Spend a few minutes on calculating tax liabilities and some of the issues on that. A qualified farmer for tax purposes is if at least 2/3 of his or her gross income from all sources in either the current or prior years was from farming or ranching. Again, gross income is all income received in the form of money, goods, property, and services that is not exempt from tax. One of the reasons is for being a qualified farmer is that a qualified farmer does not have to make estimated payments over the year, either on your monthly paycheck or similar to your monthly paycheck, or make quarterly estimates like non-agricultural self-employed people do. They must file their tax return and pay all taxes by March 1st of the year following the tax year. They may choose to make a single estimated payment by January 15th and then wait until April 15th to file the tax return and pay the balance of taxes owed. This is quite common for the snowbirds. People go south to Phoenix or Florida or wherever they go. They spend Christmas at home. They go in and see their tax preparer, make an estimated payment, and then head down south for 3 months and then come back. It's all okay. If you are not a qualified farmer and owe at least $1,000 in taxes, you must make the quarterly estimates. And when you make those estimates, it needs to be 90% of the current year's taxes or 100% of prior year taxes. Personal exemptions as of 2018 through 2025 is suspended, so we no longer have those. We have an amount there because they always put that in if the tax law changes they needed to calculate future personal exemptions. The standard deduction for years 2018 through 2025 is $12,000 per person. So if you are married filing jointly, $24,000. If you are single but head of household, it's $18,000. And of course, the credit for being elderly or blind, there's still an additional credit there. The child tax credit under the new law is $2,000, whereas last year it was $1,000. Qualifying children must be under age 17, and it does phase out if the parents that are married filing jointly have adjusted gross income of $400,000 or more. A Social Security number will be required for each child. Under the new law, the taxpayer may have a credit of $500 for each non-child dependent. So mom or dad or Aunt Susie or whoever moves into your house, is fully dependent on you, you can get that $500 credit. The new kiddie tax, they are taxed on earned income at the single individual rate. Now, if there's taxable income from trust, estates, capital gains, etc., that is at different rates than the individual rates. We've heard a lot about Section 199A, which is qualified business income, and if it comes from a partnership or a subcorp or sub-S corporation, an LLC that files as a partnership, the individual can get a deduction of 20% of the farm profit, but there are some limitations on this. There's significant confusion by people across the country on this that are very knowledgeable about tax code and legislation. In fact, in 10 days, I and the Other members of the Farm Income Tax Task Force will be meeting with the IRS and some lobbyists and legislators, and this is one of the topics we will be discussing, is where this is. The IRS has yet to put out any guidance on this rule. Net operating losses, if you lose money on the farm, there's some new limitations on this. It's not a major issue for most people, but whether it's carry forward and backwards and that type of thing is important if you get into this. You need to talk to your tax preparer about the application of the net operating losses. We can skip this slide. Itemized deductions. We do not have, generally have itemized deductions unless you are in one of the high tax states. Mortgage interest is allowed subject to indebtedness limitations of $750,000 if you are married filing jointly. A farmer or rancher may choose, and it is perfectly legal, to donate grain in lieu of cash to a church or other charitable organization that meets the qualifications. Generally speaking, it needs to be a 501c3 or similar type organization or have that tax status. Visit with your tax preparer about this. Capital gains. Long-term capital gains are on assets held more than 1 year. They are taxed at the tax rates you can see in that lower box. Whereas short-term capital gains, gains on assets held for 1 year or less, are taxed as ordinary income. The new individual tax rates, of course, they changed this year. 10% for the first $19,050 if you are married filing jointly, and it goes up from there. C corporations, the new tax law, all profits, all taxable income is taxed at 21%. There's no marginal tax rates for C corporations anymore. So where to from here? The technical corrections bill is in the works now. Congress is trying to address some of the issues that emerged from the passage. This is standard procedure for Congress when they're looking at this. And as I said, the Treasury Department, or they'll delegate that to the IRS, must issue rules and regulations pertinent to the new tax law. There has been no guidance or very little guidance coming out of that. This legislation was passed December 22nd, so they've been scrambling to address the issues with this and to gear up for the normal tax period that we're now through. I like this slide because I use it to point out to people that the Schedule F does not accurately reflect true profits or losses on a farm. It is a tax reporting form. There are depreciation can be skewed. We can have prepayments, buy extra supplies that are used next year in order to bring our profits down. We can delay payments. We can take delayed sales, whatever it is. Some of us that live on the farm will, I say hide, don't like to use that term for IRS purposes, but we include some of our family living expenses on the Schedule F. And of course, is it accurately reported? It is, again, if you're going to look at true profits and loss for the business or for a particular enterprise, use other formats, not the Schedule F. For more information, as I've said a number of times, please contact your tax preparer to get information. Publication 225 is or the Farmer's Tax Guide is available from the IRS. It has really good information in it about farm taxes. You can get all sorts of forms and information from the IRS.gov. You can seek other professional counsel. I have my email address there. It was on the first slide as well. It's jtranel@colostate.edu. You can email me questions. I will not provide specific guidance on the tax law, but I will help you to understand the issue well enough where you can make a decision or you can ask the right questions of your tax preparer. As I said, at www.ruraltax.org, we have a number of fact sheets, sample tax returns, and a plethora of other information. Likewise, on our ABM webpage at CSU, it's wr.colostate.edu/uppercase A, uppercase B, uppercase M. We have all sorts of information, not only on taxes and leases and drought strategies. You can get those decision tools. Again, there's myriad other information available there. With that, I want to say thank you and turn it back to Jenny. If there are any questions on expenses or if any more came in on income, whatever the case may be, we can open it up, Jenny.
Thanks, Jeff. We do have some questions. First off is, where would someone go to find the 20 factors test to determine whether a worker is an independent contractor or an employee?
That will be available on the ABM website. After this webinar, I will make sure it's there, and if not, I will get it over to you, Jenny, and you can make sure it gets uploaded over the next couple of days.
Okay.
If it's not there.
Next question. The amendments I put on my soil last more than a year. Should I deduct them in the year I purchased them, or do I have to spread that out over time?
You have a choice on those. If you put, say, fertilizer on there or other amendments, if you can expense it in the year of application, or if you are, really planning to save those and utilize that in future years, and you have low profits this year and you'd like to save some deductions for future years, you can do that. The percentages of that split, you would need to look at some of the best management practices available from most county extension offices, or at least some of them. The local FSA NRCS offices have some guidances. You can get those off the internet. There's some fact sheets on, what's the life expectancy of a particular amendment to that ground going to stay there before it is used, or it evaporates, or whatever the case may be.
Thank you. Next question. What is a kiddie tax?
Kiddie tax is if a dependent child needs to file his or her own tax return. So maybe generally most youngsters do not have sufficient income to pay file their own his or her own tax return. They're just included as a dependent on mom and dad's tax return. However, there may be circumstances in which that child needs to file a tax return and pay appropriate taxes, and that's what we call the kiddie tax.
Thank you. Next question. Is there an investment limit on the amount of bonus depreciation that can be utilized in any one year?
I'm not aware of any, but don't hold me to the fact that there may not be any, but I'm not aware of that.
I'll answer this one then. There is not an investment limit on the amount of bonus depreciation that can be taken in a year.
Okay, good. Thank you. I didn't think there was, but I wasn't going to say for sure.
No problem. Those are all the questions that we have from the chat box. So thank you very much, Jeff, and thank you all for attending. If anyone has any comments or feedback about the webinar, please feel free to leave any comments in the chat box for Jeff and myself. At this point, if there's any questions over the phone, I would like to open it up to those. Okay, since there are no more questions, I would like to thank you all again for attending our webinar. I'd especially like to thank Jeff Tranel for speaking this evening. If you have any other questions after the webinar, email Jeff at jtranel@coloradostate.edu. And please visit the link that's posted on your website to find the recording for this webinar if you would like to watch it again. If you have any other issues, please feel free to email me as well. We wish you all a great rest of your evening. Thank you for attending.